Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, the labour market isn't breaking, leaving the Fed on track to keep on hiking. Looking ahead to next week's CPI report. We begin with the big issue, another solid jobs report.
We still have a very strong labor market.
An exceptionally strong labor market.
It's solid.
And herein lies the challenge for the Fed.
Talking about a continued hawkish narrative, and this just feeds into that.
It's all about the Fed. It's all about central banks.
There's no pivot. The Fed has got to keep going.
It's going to keep the Fed on track for a 75 basis point move at the next meeting.
We kind of can see this train, wreck in motion, in slow motion, so to speak.
Slowing slowly is the right way to put it.
We know that the labor market is going to continue to slow, and at the same time, the Fed is going to continue to hike.
Right now, with a strong labor market, this is the relatively easy part of the Fed's tightening cycle.
I think they want to crack the labor market, and there's lots of room for them to do so.
This market's a train wreck. Equities down hard and yields higher. Let's get to the team. BlackRock's Gargi Chaudhuri, Kathy Jones of Charles Schwab, Krishna Memani of Lafayette College. And let's start with your reaction to that payrolls report earlier this morning. Kathy, first to you.
Well, I think it was remarkably close to expectations. There's a lot of good news in there in that we continue to get positive job growth, but without an accelerating wage growth. And I think it's the wage growth that really matters for the Fed. That's kind of the ultimate measure of how tight the market is. Seeing a little bit of easing in the wage growth numbers. So I think that's a positive. I think, though, it does keep us on track for 75 basis points at the next meeting, and that's what's gotten into the markets today.
Gargi, your take?
Sure. Agree with some of the things that Kathy talked about. Obviously, very much close to consensus. What I focused on was actually the participation rate. I think that is something that would displease the Fed. They're obviously looking for participation to pick up, for more workers to come back into the economy. We did not see that. I would also say that looking at some of the revisions lower for last month was interesting, especially on the private number that I focused on. So all in all, this is probably not the way that the Fed had expected the numbers to turn out, especially if we were expecting any kind of pivot in the market. This makes sure that we go 75, obviously barring a very, very soft CPI print, which is not at all my base case, and we can talk about that. So this keeps the Fed in play, and that's what the market's pricing off of.
We'll get to the CPI report in just a moment. Krishna, do you think the labour market and the strength we've seen over the last few months overstates the strength of the economy elsewhere?
Well, so, if you are talking, it depends on which part of the economy you are talking about. I think if you're talking about housing, some parts of manufacturing, things are slowing down quite quickly. Having said that, I think this is a very diverse economy, and overall, the strength of the labor market is telling you that we are nowhere close to a recession. One point, Kathy made the point that this was close to consensus, and I agree with that fully. And I think if you can picture a scenario where we hadn't gone up 5% beginning of the week, we probably would not have gone down as quickly as we did today. So I think that sort of tells you we are looking for a Fed pivot, and we are not going to get one. And that's what's keeping the market unbalanced far more than big changes in the labor market itself.
Spent the last 6 months talking about a Fed pivot. Meanwhile, they've added about 300 basis points to Fed funds. Kathy, we're doing it all over again. What is it going to take to get this Fed to pause? Not this.
Yeah, we've been talking about not a pivot, not a pause, but really the pace. The pace is important. And one of the concerns that I have is that the pace has been so rapid. They've tried to front load all these rate hikes, but we're starting to see a lot of volatility in the global markets due to the rise in the dollar, a lot of tightening in financial conditions very abroad as well as domestically. And the rate of change, the volatility has picked up in all the markets, even the Treasury market. So I think that this next meeting, 75 seems to be where they want to go. After that, if they don't start to at least slow the pace and indicate that maybe 4.5 and the Fed funds rate is the upper band for the Fed funds rate target, then we have a much more serious downturn in the economy to talk about. So I'm not waiting for pivot. I'm not waiting for pause. I'm waiting for the pace to slow down.
Gargi, have we got a recipe here for stagflation?
Yeah, I think so. I think what we'll see on Wednesday is that, core inflation still remains pretty strong at, I would imagine, somewhere around 6.5%. Headline inflation will slow down. And, while that'll slow down, it'll still remain at above 8%. So on one hand, you have inflation remaining extremely sticky. We'll see some of those services inflation prints, especially as it pertains to shelter inflation, remaining very, very hot. And on the other hand, we're going to probably see some of the realization of the SEP forecast from the Fed, where obviously we saw them pointing to that slowdown in growth, whether it's 1.2% or whether it's around that, lower, higher. It's definitely a slowdown. So the combination of the two certainly does lead one to believe that, we're entering something that's near a stagflation. That's certainly something that people are Googling a lot. And I think that till we see a very sustained slowdown in core inflation, I imagine that the Fed will have a really hard time pausing. Or certainly we're further away from pivot, but even for them to pause, I think we'll need to see 2 or 3 months of CPI data coming in at a 0.2 or a 0.3.
Krishna, two things then. A, do you agree with that assessment? And B, if that's the case, is bad news just bad news for this market?
Funny that you say that, because I think we have been too conditioned over the last few years. Having said that, I think stagflation is certainly a possibility, but perhaps it's a little too early to kind of say that that's really the final outcome for 2 reasons. One, I think the COVID-related issues may have faded from the good sector of the economy, but on the labor side of the economy, it is still an issue, and we see that in the participation rate. And for you to believe that the stagflation is going to be the case, you have to believe that participation rate is never going up. I mean, one could certainly make a case that may be the case, but it may be a little too early to conclude that. And second point is you have to conclude that the lag in the impact of monetary policy has basically disappeared. That is, what we are seeing today is what the impact of the monetary policy is going to be forever. I think, again, that would be a pretty heroic assumption. So I expect things to slow down, perhaps much more slowly than we would have seen earlier because of the persistence of some of these issues. But things are certainly slowing, and they're going to slow even further. So and inflation, therefore, will probably come down as well. Again, at a slow pace, but lower nevertheless.
So would you be buying the long end of the Treasury market here, Krishna?
Yes, I think so there are 2 issues with respect to that. One is, where do you think the terminal rate is going to be? And what would be the Fed's reaction on the back of that terminal rate if things remain as hot from an inflation standpoint or not? So for you to not buy the bond markets here, you have to conclude that, one, the monetary policy is going to be at some point which would capitulate without really killing inflation. If that's the case, then certainly bonds would probably underperform in a meaningful way. I just don't think that is the case. And the second thing that you have to believe is when we get to a pause or when we get to the terminal rate, we will stay at the terminal rate for a very, very long period of time. Again, I don't think both of those are real good possibilities at the moment.
The issue a lot of people have, Kathy, and I've brought up this a million times this week, is that we could very well be in a position where we go into recession and this Fed doesn't cut. I think that's a really important dynamic to start to consider because, Kathy, that's not something we've experienced for a long time, if at all. So, Kathy, how do you think the bond market would respond to that in a recession and a Fed that doesn't cut in that recession?
Well, I think you just get more and more inversion of the yield curve. We already have a steeply inverted yield curve. If the Fed persists and we go into recession, inflation will be coming down, especially if we are in a recession. I think it's already going to come down. I agree with Krishna. So you just get more and more yield curve inversion, which is, again, unsustainable over the long run. I think the Fed would have to react. Now, I mean, I'm old enough to remember the early 1980s when Paul Volcker, kind of persisted for a while, but he did pivot even when inflation was high in 1982 because we were going into recession. So I think it's unrealistic to think that the Fed will just sit on its hands if we go into a deep recession and we see inflation coming down, and especially then because we're already doing QT, and that's adding to the tightening in liquidity. That's adding to the pressure on the economy and on the global economy. And this is a global tightening cycle. It's potentially a global recession. I find it hard to believe the Fed just sits on its hands if that develops.
I do wonder how much longer we'll be doing QT for, and we'll talk about that in just a moment too. Gargi, this is toxic for a lot of people. Bear market in bonds, bear market in stocks. You look at the moves today, we're down 3.7% on the NASDAQ. What are yields doing? Yields are climbing higher. On a 10-year by 4 basis points, on a 2-year by 4 basis points. Gargi, when do bonds start behaving like bonds in a moment like this one?
I think that they are going to start behaving like bonds, and by that I assume you mean that they're going to be a ballast in your portfolio.
Precisely.
So they'll actually be beneficial in an equity market sell-off. That'll happen once we get to that level of yields that is sort of very attractive to U.S. and non-U.S. investors. And I think that could probably be somewhere around 4% or a little bit higher on the 5-year note. We saw that earlier, and we bounced from there. Same with 10s. I think if 10-year treasuries get to 4%, a little bit higher than 4%, I think that could be that level. So just looking at valuations. But I also think the macro makes a difference. So what would have to happen to the economy? And I think we're obviously, Krishna was talking about this before, we're seeing some signs of slowing down. Obviously, the housing market comes to mind, certain segments of the manufacturing sector. But I think we'd have to see a broader base slowdown. So when we see that, and we haven't seen that yet being the very important word there, we will. And we see earnings also slowing down. And obviously, the next couple of weeks are really important for that. I do believe investors will gravitate towards that belly of the curve, gravitate towards that 5-year part of the curve. So far, we've actually seen a lot of move into the front end. If we just think about the ETF flows into sort of just the Treasury, SHY and SHV, just 1 to 3-year part of the curve, that's been immense. I think that'll move out to the 5-year sector, to the ag, once we start seeing a little bit slower pace of growth, a little bit slower, broader economic outlooks, and also when yields get to a little bit higher level, and I call that about a 4% on 10-year treasuries.
I've got a challenge for one of you next. We're going to talk about our star, and one of you has to define what on earth that's about. Gargi Chaudhuri, Kathy Jones, Krishna Memani, sticking with us. Coming up on this programme, the auction block, high-grade borrowers regaining momentum despite rising costs and more volatility. That conversation up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe. A muted ending to a busy week. 30 billion euros of debt sales, ending with this year's 41st day without a single deal. In the US, high-grade bond sales hitting 13 billion, weekly volume topping estimates for the first time in 4 weeks, and another slow week in high yield. A Canadian energy company, Enerflex, responsible for the only debt sale this week, raising $625 million. Sticking with credit, PGIM's Mike Collins seeing spreads starting to move closer to fair value.
If you look at the underlying fundamentals in the debt markets from a credit risk perspective, yeah, default rate expectations are going up, earnings expectations are coming down, margins are getting compressed. But are we going to have a big increase in defaults? Are the big banks going to default on their debt? Unequivocally, no, right? And are they, providing really attractive yields? Absolutely, yes.
Krishna, you said you were leaning into the long end of the Treasury market. Can you say the same thing about high yield credit?
Oh, no, not at all. I think the point about banks not the kind of defaulting, that's a ridiculous point. That doesn't really matter. We don't have a banking sector problem at the moment. Having said that, we do have a corporate debt problem. We issued a lot of debt over the last few years, and if we do get into a recession, there are lots of parts of the high yield market that would be very vulnerable. The challenge with the high yield market really isn't that spreads or the defaults are going to be through the roof. It's just that it hasn't cheapened enough relative to what else is going on in the world. That is, given the risk of a recession sometime in 2023, if things don't work out the way we expect, the likelihood of defaults going up meaningfully is very high, and we are not pricing that. That's really the core problem for the credit markets.
This is something I talked to Rick Reeder of BlackRock about a little bit earlier. Gargi, I'd love your thoughts on it too. Same company, of course. When you look at spreads, it doesn't scream recession. But when you look at price and yield in the bond market, this is what everyone's been asking for the last 10 years, isn't it?
Yeah, I mean, look, we've talked about the yield of dreams before. This is exactly what we've been looking for. We were all familiar with Tina, there is no alternative, and now it's Tina who. We have options. There are areas to go into in the market which is giving you yields. Obviously, you were talking to Krishna about high yield. That's an option, but I would say that you're probably, at least for now, as we wait for some of that recessionary pressures to enter the market, which are surely coming if the Fed keeps on pressing at it, I would say you're supposed to stay a little bit further up in quality. So IG and front-end IG, which is yielding you about 5% or a little bit higher than that, is perhaps where you're supposed to sit and earn that yield and earn that carry. So that's where we're telling investors to go. Definitely looking at some of these spreads and looking at the all-in yields are amazing, especially in a world where equity markets can probably continue to still show a little bit more volatility between now and the end of the year.
Many people think there's more pain to come. Something hasn't broken yet, and this Fed will keep going until something breaks. Scott Minerd at Guggenheim had that to say too. The end of Fed tightening will come when something breaks, and from where I sit, cracks are forming. Kathy, can I get your view on that? The absence of things breaking, a reason to step back and be patient and wait until something does?
Yeah, it's been a big concern recently because of the pickup in volatility. So when I look a lot at the volatility in the bond market and the underlying treasury market, and that is at levels that you normally associate with a pretty difficult financial environment. And that's starting to move up, and it's moving up at an accelerating rate. So if that continues, then that's going to reverberate throughout the system. We also have less reserves in the system now. And as I mentioned before, a very strong dollar, which is inflicting pain around the world. We had the problem in England. Now I think that's a self-inflicted wound, but nonetheless, you start to see these pressures build up in emerging markets, high yield, bank loans, private credit. Those are the places where I would look for the cracks to start forming. And as long as the Fed is pushing real rates very high and the dollar follows, there is likely to be some sort of fallout down the road. Doesn't mean it's a systemic problem. No, I don't think it's anywhere on the order of 2008, 2009. But every cycle ends with the most leveraged or the weakest link cracking. And I think we'll get there at some stage of the game if the Fed doesn't slow down.
Every market crash ends, and we stop panicking when policymakers start to. Krishna, that's a line you've used on me over the years when we've talked and we've had a big market move lower. Many people think the Fed might not step in this time until, of course, we saw the Bank of England the other week. And now this week, we started to have a conversation about this concept, star. Now, Krishna, you can explain it all for us, but I'll make it super simple. There is this belief that there is a rate that the Fed can go to before we start hitting some real turbulence in financial stability. And there is another rate where they can go to which might stabilize the economy. They're at different points, and they bump into financial stability concerns before they roll over this economy. Krishna, can I get your thoughts on that?
Sure. So this, our star concept is an interesting one, which is we are attributing a level of precision to things where there is no precision whatsoever. So we don't know where R is, let alone R star or R star. If we knew where R star was, everyone on Twitter was looking for a pivot, will have it on their banner along with the Ukrainian flag. The point I'm trying to make is we don't know what that number is. We cannot estimate what it is in real time. Therefore, it is a good theoretical construct, backward looking. However, from a policy-making standpoint, especially in today's context, it's a meaningless number. There is some R star. However, what that is and whether that moves around a lot, we just don't know.
Do you agree with the sequencing, though, Krishna, that you bump into financial stability concerns before they get what they want to bring down inflation?
So if the Fed hadn't succeeded with all its moves during the financial crisis in terms of making sure that banking system did not blow up, I think one could have made that case. However, I think what we learned during the global financial crisis is if the issue in the market is liquidity, Fed is extraordinarily creative to make sure that that doesn't end up being the cause that takes everything down. And take the case of the UK for a minute. I think if the Bank of England opened a discount window to the pension plans, I think this problem about collateral actually goes away, and we can go back to our merry way of watching policy based on what the economy is doing. So there are plenty of tools available to the Fed to manage liquidity in the marketplace, and they will do that. And I think R** is an important construct, but I don't think that is going to be the driver in the near term.
It's something Governor Waller pushed back against as well in the last 24 hours. Krishna, going to stick with us alongside Kathy Jones and Gargi Chaudhuri. Coming up on this programme, up next, still ahead, the final spread, the week ahead, featuring US CPI. Another big inflation print in America. That conversation just around the corner. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. Let's get you to the week ahead, the final spread. A week ahead that looks a little something like this. Another busy week of Fed speak with Vice Chair Brainerd and Charles Evans on Monday, followed by Mr. Kashkari, Bauman and Barr throughout the week. Honestly, they ever stop? The Fed minutes and US PPI coming up on Wednesday, initial jobless claims and US CPI on Thursday, and we round out the week with US retail sales and big banks reporting on Friday. For a final round, the rapid-fire round, Gargi Chaudhuri, Kathy Jones, Krishna Memani, to the first question of that rapid-fire round. Looking ahead to CPI next week, 7 or 8 handle on headline CPI next week, 7 or 8. Kathy?
7.
Krishna?
7.
Gargi?
8.1.
There we go.
8.
Very precise. OK, the final 75 basis point hike of the cycle. Do we get that in November? Yes or no? Krishna?
No.
Gargi?
Yes.
Kathy?
Yes.
The Federal Reserve's final hike of the cycle. Do we get that in 2022, 2023 or 2024? Krishna?
2023 first quarter.
Gargi?
2023.
Kathy, final word.
2022.
To the three of you, thank you. Enjoy the weekend. Gargi Chaudhuri, Kathy Jones, Krishna Memani. We'll do it all over again next week from New York. That does it for us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.